Netflix stock is down 35% from its all-time high. Investors are panicking over rising costs, but they're ignoring the explosive growth of Netflix's ad business. This sell-off could be a massive opportunity, and I've got my own money on the line. Across my combined portfolios, Netflix is my largest position, with over $4,000 invested in the stock. Today, we're going to dive deep into Netflix's business, and I'll reveal the exact price I'm willing to pay for Netflix stock towards the end. Every business in today's economy wants a subscription business model. They're predictable, consistent, and often highly profitable. Netflix is the perfect example of a successful subscription-based business model. Since 2015, Netflix has grown the number of paid subscribers on their platform from 71 million to 325 million in 2025. That's an annual growth rate in paid subscribers of 16.5%. over the past 10 years. But increasing the total number of paid subscribers isn't the only way that Netflix can grow. Netflix have introduced new pricing tiers and slowly increased the price of their subscription over time to more closely align with the value that the company provides to their users. As you can see from this chart, Netflix's subscription prices have changed a lot over the years. In 2015, their standard subscription plan was priced at $9.99 per month. Since then, the standard subscription price has doubled to $19.99 per month. You'll also notice that since 2015, the price of Netflix's premium subscription plan has more than doubled in price from $11.99 per month to $26.99 per month. And then the third way that Netflix plans to grow is through advertising. For years, Netflix avoided placing adverts on the platform, and that was part of the appeal, a seamless, uninterrupted viewing experience. But now, Netflix is using advertising to supercharge growth. The company has gone from $0 in ad revenue in 2022 to expected advertising revenue in 2026 of $3 billion, more than doubling from the $1.5 billion in ad revenue generated in 2025. Netflix had to build its own ad technology infrastructure, making it easier for companies to buy ads on the platform. The company says programmatic buying, meaning companies buying ads for series hosted on Netflix, is growing rapidly and is on track to become greater than 50% of non-live ad revenue. This is important because it shows Netflix's advertising revenue isn't dependent on hosting costly live events. The advertising base, meaning the number of advertisers on Netflix, grew more than 70% in 2025 to more than 4,000 advertisers, suggesting demand from advertisers is very strong. And this competition for ad placements on Netflix's platform means that advertisers will have to pay more to guarantee coverage, therefore strengthening Netflix's position. Now I'm going to show you the exact numbers that make me super bullish about Netflix stock. First, Netflix's revenue chart is a beautiful sight. Since launching their streaming service back in 2007, Netflix has grown revenue from $1 billion to over $46 billion in the past 12 months, meaning their revenue has grown at an annual rate of 20% over the past 10 years. Netflix's growth rate has slowed as the company scaled, but in the last 12 months, growth re-accelerated to over 16%. Netflix's three growth levers, subscribers, pricing, and advertising, give me confidence that revenue can grow at around 15% annually for the foreseeable future. If one of the three growth levers were to stall, it would pressure Netflix's growth rate. However, in their latest earnings call, the company noted that they've only captured 7% of their addressable revenue pool and about 5% of global TV viewing time, suggesting a long runway for growth. The story of Netflix's rise can almost be summed up by a chart of their free cash flow. This is the money left over after all expenses are paid. You can see that in the early years of streaming, the company ran large deficits to fund growth. But since 2022, Netflix has generated a combined $30 billion in free cash flow. Instead of being reliant on outside funding, the company now has a war chest of capital to fund its own growth. In the past 12 months alone, Netflix generated $11.89 billion in free cash flow. As Netflix investors, we also want to keep a close eye on their content budget. This is the amount of money Netflix spends to purchase, license, or create content to host on their platform. You can see that in recent quarters, spending has started to rise, which is one of the reasons why the stock price is down. As a Netflix investor, this doesn't concern me. Netflix have proved in the past that they can achieve high returns on their content investments. They have systems in place and highly capable people working to grow the company without destroying value. To make this deep dive complete, we're going to discuss 3 tailwinds and 3 threats that the company faces. Then we'll look at Netflix's valuation, and I'll reveal the exact price I'm willing to pay for the stock. Tailwinds are economic forces that help a business grow. So the first tailwind for Netflix is the shift from mainstream television to streaming services, not only by consumers, but also by advertisers. As cable television slowly fades into obscurity, those advertising dollars will be allocated to platforms like Netflix. This is why Netflix's ad business is growing so fast. Advertisers were patiently waiting for Netflix to launch their own ad business. Now the ad platform is open for business, advertisers can get to grips with how to best utilize it. If Netflix can help advertisers make outsized returns, those profits will likely be reinvested, making Netflix even more money over time. The second tailwind for Netflix is pricing power. Pricing power is the ability for a company to raise prices without losing customers. Netflix's pricing power comes from the value they provide to consumers. They have the largest, most diversified global slate of premium entertainment. You can't find the quality of Netflix's service anywhere else. So if you had to have a single streaming subscription, it wouldn't be Disney Plus or Apple TV or Prime Video, but it would be Netflix. This gives Netflix the ability to raise prices above the rate of inflation and therefore increase profit margins over time. We can see from this chart that price increases have positively impacted Netflix's operating margin, increasing from less than 5% in 2016 to over 30% today. The third tailwind for Netflix is their content flywheel. Netflix spends more money on content, which makes the business stronger and more efficient. This helps to grow their subscriber base and keep existing subscribers more engaged, making them less likely to leave even after price increases. And the extra profits from those price increases allow Netflix to reinvest even more money into their content, allowing the cycle to repeat itself. Now I'm going to give you 3 threats that Netflix faces. These are forces that could make the business weaker. The first threat for Netflix is increasing competition in the streaming market. Companies like Alphabet via YouTube, Disney via Disney Plus, and Amazon via Prime Video all want a piece of an increasingly profitable streaming market. Of course, as things stand, Netflix is by far the leader of these premium streaming services. However, YouTube, which doesn't directly pay for content, actually has more share of TV watch time than Netflix. So although they might not seem like they're competing in the same industry, both Netflix and YouTube are competing for a similar audience. The second threat for Netflix is rising content costs. Like I mentioned before, Netflix is very efficient when it comes to content spending, but if other companies decide to start bidding wars for licensed content, it could mean that Netflix is forced into paying more for the same content. Fortunately, Netflix has built its own content production studio, so if a licensed content bidding war were to commence, I suspect Netflix would just allocate more of their budget to producing their own content. The third threat to Netflix is an economic downturn. We haven't really seen how Netflix's business would hold up during a prolonged economic downturn. The COVID pandemic actually strengthened the business because everyone was locked indoors. However, a full-blown economic recession creates a different problem. Will job losses lead users to cancel their Netflix subscription? Unlikely. People pay 2 to 3 times more for their local gym membership. If they have to choose between their gym membership and Netflix subscription, I think the answer is pretty obvious. I believe that in a bad economy, Netflix is actually positioned to improve their market position because weaker, heavily indebted competitors will have less buying power for licensed content, meaning that Netflix will have somewhat of a free run at gaining market share. Alright, now for your favourite part of the show. We're going to look at Netflix's valuation. Then I'll show you the exact price I'm willing to pay for the stock. First, Netflix's PE or price to earnings ratio is pretty undemanding. The stock currently trades at a 26 trailing PE. That's based on Netflix's earnings in the past 12 months. However, for a fast-growing company like Netflix, we really should be looking at the forward PE ratio. This takes into account the company's expected earnings over the next 12 months, and that sits even lower at a 25 multiple. If we look at Netflix's price to earnings from a historical perspective, you can see the multiple the stock trades at has fluctuated significantly over the past 5 years. In 2021, the PE multiple traded at a high of 65. Then by 2022, the multiple crashed down to a measly 15 times earnings. If we look at Netflix's stock price over the same time period, you can see that 2022 was a fantastic time to buy the stock, increasing from around $20 per share to $80 per share today, a 4x increase in 4 years. At the time, investors feared that Netflix was losing subscribers. Since then, paid subscribers has grown from 230 million to 325 million today. So with Netflix's PE multiple at the lowest it's been since 2022, I believe the stock's valuation provides a massive opportunity for outsized returns. To calculate what those returns could look like, we're going to use Qualtrics' DCF calculator. We have to provide assumptions for Netflix's earnings per share growth over the next 5 years, and then decide on an appropriate PE multiple for the stock to trade at. Netflix's EPS growth has been insane. Over the past 10 years, EPS growth compounded at an annual rate of 59%. Over the past 5 years, EPS has grown at 30%, and it's actually re-accelerated to over 45% in recent years. This increase in EPS growth is a combination of revenue growth, increasing margins, and share buybacks. So the base assumption that I'm going to use for our valuation model is 20% EPS growth. Then for Netflix's PE multiple, I'm going to use 30 times earnings. Based on these assumptions, Netflix stock could increase from $85 per share to over $230 per share in the next 5 years. That's 22% annual gains from today's price. Even if the stock trades at a 25 PE multiple, you're looking at an 18% annual return. And then if we were to be super bullish about Netflix, with a valuation multiple at say 35 times earnings and 25% EPS growth, you're looking at a 31% annual return. That's a 4x from today's price, similar to the scenario that played out in 2022. Like I mentioned at the start of the video, I've got over $4,000 of my own money invested in Netflix. There's a massive opportunity for investors to make a lot of money holding the stock over the next 5 years.